So today we're going to be looking at is chapter 27, which deals with money and banking. So far, and this is the first part of the third unit. So far we've introduced the different types of. We've introduced like this intro to econ in the first unit. Last unit we were looking at measures of the economy and really looking at things from a theoretical side. And today we're going to start our last unit, which mainly looks at policy and starts to really get into policy and how really what's going on in the economy, how things are working. Um, so with today, what we're looking at with money and banking, we first look at what is money, how do we define it, then we look at how do we actually measure it. So if we say how much money is in the economy, we can look and see how that works. Um, the last two, the role of banks and how banks create money, we look at how do banks work in our monetary system. So again, it's a really interesting chapter. One of the things we'll do either today or Thursday, we'll actually turn $100 into $1,000. Obviously, it won't be the example I would have done in class, but it'll be similar and it'll work out. So what we get into looking at, so when we think about money, one of the things that we're interested in, how can we have a world without money, right? So what would we have to do? And without money, we would have to still exchange goods because we talk about specialization and um, all that stuff. But how would we actually go about exchanging our goods? And to do that, we would be in what's called a barter system. And in a barter system, basically what we have to do is I'm going to trade one good for another. So if you think about something like a trade, if you say, well, I'll trade you a water for a Coke, or I'll trade you an elementary school. If elementary school in the movies, right? Everybody brings their own lunch. I don't know how many people still take their own lunch versus get school's food, but one of the things they said was, as common in movies, is I'll trade you my apple for your orange or whatever the case is, right? So when they're doing this, they're participating in a barter trade. That is, again, just one good for another. And at first, it sounds great, right? We just trade our goods and we're happy. But one of the things that's going to come up is there's this huge challenge. That is, if I'm going to provide my service or my good to you, you have to have something that I want, and I have to have something that you want. So what we require, and with any type of trade, what's required is called this double coincidence of wants. That is, two people have to agree that that means I have to have a good that you want, and you have to have a good that I want to have. If so, if we were still in our face-to-face classes, and suppose we had a barter system, I may stand outside the door of our room and say, "All right, what do you have?" And suppose it was a Spirit Airlines style class where every class is a la carte. Um, I would come in and say at the beginning of class, I'd say, "Well, what do you have? Do you have something I want or no? If you don't have something I want, you have to go find something that I want to be able to get in." Right? And same thing if we think about like your barber, hairstylist, whatever the term is for you. If I go down to get a haircut and I don't have what my barber wants, I don't get a haircut that day. Right? And so we have these issues that come up. And again, double coincidence of wants can be a challenge. So to make this easier, so to ease this, what if we made make a universally accepted or demanded good or item, right? So if I had a good, or if I had an item, I should call it an item. If I had an item that if I gave it to anybody, they would accept, they'd be happy to take, and they would be willing to exchange their services for, it makes this process a lot easier, right? So if I knew that everybody wanted bottle caps, right? If I knew everybody wanted bottle caps, I could go around, have a little bag of bottle caps and pay people with bottle caps. Or if I knew there was something else that everybody wanted, I could use that. And what we've done as, I guess, a society to make this universally accepted item or universally demanded item, we created money. Money, or in our case, money, right? US dollars, Canadian dollars, pounds, euros, etc. So when you think about money, well, we're going to define it as going to be an item or a thing that really has four main functions. So we have money, and it's going to do, and we kind of define it by what it does. So the first thing that we're going to look at is this medium of exchange, right? And this is the scenario, the example I was mentioning about 2 seconds ago, where we need this widely accepted method of payment. So in this case, what we're saying, it's exactly what it seems like, is I pay money for a good or service. So if I go down to my barber and I offer her money for a haircut, right? She'll cut my hair and I'll be good to go. If I don't take any money down, I won't get a haircut, right? It's kind of right. It's that universally accepted method, and it works. Well, for the most part, fairly well for us. So we have a medium of exchange. Second thing we're interested in having is this store of value. And basically what this does is we're saying that I want something that can, and what it's saying is preserving something that can preserve economic value so that, okay, something that preserves economic value so that I can spend in the future. Keyword here is the future. That is, I can save my money for tomorrow. By tomorrow, it could be literally tomorrow, but by tomorrow, I'm also referring to maybe 10, 15, maybe 2 months from now, maybe 10 years from now, maybe during retirement. But if I to for a money to for an item to be considered a good system of money, I need to be able to excuse me, I need to be able to store it. It needs to be worth something today, and it needs to be worth something 50 years from now. So if I have a $20 bill and I stick it in a drawer, I stick it in a little lockbox for 50 years. 50 years from now, if I pull it out, it'll still be worth $20. It may lose purchasing power, but it's still $20. So when we look at this store of value, again, I want something that I can use tomorrow. So if we say we made like a milk currency, right, where everybody carries around a gallon of milk and you throw milk in a savings account and all that, you can probably imagine there'd be some problems with that because after about two, maybe 3 weeks or so, your milk's going to start to spoil. And whereas something like a $20 bill, in 50 years from now, it'll be a $20 bill. If I have a gallon of milk and I store it for 50 years, or say store it for 20 years, it's going to have the same result. It's not going to be quite like your paper currency. It's going to kind of be gross. So we need something that's durable, that can stand the test of time, and so on. So we have our store of value. The next thing we have is called a unit of account. And this is kind of like a yardstick of value. So basically what this is saying, and it's phrased as a common way to measure market value. There are certain things that we agree that the price is about right for. So if I go and I buy a bottle of Coke or a bottle of pop, whatever the case is, if I buy it from a vending machine and it's $1.25, right, I kind of take that as, that's an acceptable price between like $1.25 and $1.50. We oftentimes consider that acceptable. If you go to a vending machine and they're charging $20 for a bottle of Coke, that's probably, we're gonna think of that as not being a good price, right? We're gonna consider that to be too high. We would expect people to not buy that. Similarly, if you went to the vending machine, it was charging a nickel for a or 5 cents for a bottle of Coke. Same thing, but this time we're going to say that's a kind of a silly good deal, and everybody's going to jump on that. So we kind of have a universally accepted measure of what are things worth. And the nice thing about this is, it gives us that yardstick. So if we had a currency that didn't do this, suppose we were trading back to our barter system, and we were trading chicken for lobster. Now today, we often consider lobster to be more of a high dollar item, whereas chicken's a cheaper protein or a lower cost protein. Um, but when we think about this, there are people who don't like lobster and they would rather have chicken than lobster, even though lobster is significantly more valuable. Or 1 pound of lobster meat is a lot more valuable than a pound of chicken meat. I'll put it that way. Um, right. So we have these things where some people don't value it as much as others. So if I were trading, so if we were in a barter system and I were trading chicken for lobster, if I come across somebody that doesn't like lobster, I might be able to get a really good value for it. However, if I come across somebody that does like lobster, I may get a really bad deal for it. So what our money does is it kind of sets a yardstick, says, hey, chicken is worth says chicken is worth say $3 a pound, lobster's worth $10 a pound, right? And we kind of have that as our unit of account, and that's what we say is the value of those things. And this last one is a standard of deferred payment. Basically what this means is I can buy something today and pay over time, right? Or I can say, hey, I'll do something for you today, and at the end of the month, you'll pay me, or whatever the case is. So if you think about your work, right? If you think about your work, you probably get paid either every week, every other week, or every month, right? And what doesn't happen is I don't go into work on Monday and then on my way out pick up a check for that day's work. On Tuesday, pick up a check that day, and so on. Instead, and the way we work is we get every other week. But instead, what's going to happen is I'm going to work for say 2 weeks, and then at the end of that 2 weeks, I'll get paid. Similarly, if I think about buying a car or buying a new house, if I want to buy a house that costs say $150,000, odds are I don't. Odds are most people don't just have $150,000 laying around to spend on their house. So, excuse me. So what I'm going to do is instead of coming up with $150,000, I'm going to go to a bank, get a mortgage, and say, "Hey, I need to borrow $150,000 to buy a house." Then they're going to give me that money up front, and then I'm going to be able to pay it back over time. So the standard deferred payment is basically, we may also think of it as a system of, that's a Y, of credit. So again, a good money, meaning as the item, a good item that's money can do all four of these things. If there's one of these things that it can't do, not saying it can't be money, but it wouldn't be considered an ideal system of currency. And we'll see, just because we say currency, we're referring to more than just the number of paper bills that are out there. We'll see how that works in just a second. Excuse me. So when you think about our types of currency, we're going to see we kind of have three kind of types. That is, three things that can be used as money. So the first two are kind of our older systems. This first one's called commodity money, and this is an item that it's used as money, but just because, excuse me, but it has value outside of it being money. So that's basically what the second part is saying. It has value for its use as something other than money. So our examples for this will be things like gold, silver, uh, and a lot of our precious metals. So I think about gold, right? If the U.S. say we scrap the dollar and we adopt gold as our currency, so everybody walks around with gold coins, and so on. Even if you have if you have a silver quarter, you have a gold dollar, whatever, like an actual gold dollar, whatever the case is, you can take that, and sometimes I think there. So I think if you have an actual gold dollar, it's worth more than a dollar in gold. But you can take that gold dollar and melt it and sell the gold for something that's not just the gold, right? So the gold has value more than just money, right? And you can, with the gold, you can make rings, you can make conductors, or with silver, you can make conductors for your computers, stuff like that. So again, commodity is an item itself that can be used. But as we went through, we're like, you know what? It kind of stinks carrying around like all these gold coins, all these silver coins. So instead, what we're going to do is we're going to develop what's called a commodity-backed currency. And for this, we're going to have a bill or a currency that has value that's backed up by gold or some commodity. So the commodity-backed currency was the US dollar before Nixon, right? And basically what he said was, all right, I have a dollar, but this dollar represents some amount of gold that's in a vault somewhere at my bank, right? So if I wanted to, I could take my dollar, take it to the bank, and get some gold back for it, and it has that value to it. And that is the U.S. dollar. That's a D. Cool. Like we said, for a large part of U.S. history, up to Nixon, that's President Nixon. Right, gold and silver really backed our money supply, and we had that. But as we go through time, we kind of developed a new type of currency, and that's called a fiat money or fiat currency. And this is a currency that doesn't have any intrinsic value, right? So it is worth what we believe it's worth. But the government declares it, so it's declared by the government to be our legal tender. So fiat money has and this is our current US dollar and most modern currencies. So US dollar, pounds, euros, etc. So their fiat money, what we're saying is, again, outside of it being sold, outside of a legal declaration that it's worth something, it's not worth anything. So if you think about if you have a dollar in your pocket or in the other room, whatever the case is, that dollar is worth, if the US government were to cease to exist, that dollar would be worth absolutely nothing. Whereas if you had like an ounce of gold, or if you had a pound of gold, which, it'd be pretty cool. If you had a pound of gold or an ounce of gold, whatever, even if the US government were to fall apart, that gold would still be worth something because, and granted, you might be in some crazy times that happened, but if the government fell apart and things were still calm relatively, that gold would still be worth whatever it's worth today. So our fiat currency, basically the main idea is that our money is backed by this universal faith and trust that it has value. Nothing more, nothing less. So if we think about something like so right now, if you're paying attention to the stock market, it's a little bit of a roller coaster right now, right? Depending on what news articles come out, that kind of impacts what goes on in the next day or so. But when we think about like the stock market, right, it goes up, it goes down, and so on. When investors are concerned about how a company is run, they're going to pull out of that company, they're going to sell their stocks, and that stock is going to lose value. However, if investor is confident in the way a company is being run, or they're confident in the future of a company, they'll kind of do the opposite, and they will go in and buy more of a share. Or if you see that, right now stocks are relatively low, maybe you might go in, buy some, and ride the wave up. But fiat money, again, it's just that faith. You think it's worth something because it's accepted as being worth something. If we all believed our currency wasn't worth anything, it would start to actually lose value. So when we say we all, that means like us as a society, not just necessarily just us as a class or me as an individual. Right? If I say I don't trust our currency, nobody cares. I could just be some random econ professor. Same thing if it's just our class of, I think, 14 or so. No one cares. It's just a few people. It doesn't really make much of a difference. But if the entire U.S. economy were losing faith in the dollar, we'd start to have issues with with the value of our currency. So we have our fiat currency, again, backed by faith, but it's there, and but it's backed by your faith that it has value. So the next little bit we get into looks at how much money actually is there. So one of the big organizations or institutions that we're going to talk about over the next couple weeks is the Federal Reserve. Right, this is going to be our central bank. They do monetary policy, but the third part for now is what we're interested, and they're going to define money based off of its liquidity. And what liquidity means is how easy can it be used, or how easily can it be used. So if you think about something like a liquid, right, like a physical item, a liquid, if I have a bottle of water, I can put it into whatever bottle I want, and it's going to, assuming it has enough volume, it's going to fit. It's going to take whatever shape it needs to take and fit into that object. If I have something like a computer and I try and do the same thing, it may not necessarily fit into every little space I can find like a liquid would. So liquid can move around, a solid doesn't. Now, when we think about currency, again, liquidity is just how easily can I move it around? How easily can I make it go from one place to another? And that's how we're going to define our money. So the two bits that we are going to look at for this, we have two main definitions of how to actually do this. The first one is called our M1 money supply. And this is going to be a rather narrow definition. But with this, what we're looking at is our money in checking accounts, currency, and traveler's checks. And traveler's checks may also be called a certified check. We really don't use them too much because if you are traveling, your credit card has an instant verification pretty much. But what traveler's checks you do is you get that money certified by the bank so that you have a check that other places don't have to worry about bouncing or anything like that. And then our checking accounts and our banks, this is the money that shows up on our phone if we open up our bank's app, and our currency is the money that's in my pocket. The other type of money that we'll see is called M2. And for this, what we're going to look at is keynote. This is everything in M1, right? So if it's a checking account, it's also in M2. But it's also going to include our savings accounts, money market funds, and CDs, or certificates of deposits. So the way our money supply kind of looks, we have our M1, right? It's somewhere in here. And then on a larger scale, outside of our M1, we have our M2. So just because your currency is an M1, if you have currency, if it's an M1 currency, it is also an M2, but just because it's an M2 does not mean that it's an M1. So an example that we may see come up with this is, what if we had the following kind of scenario? So we have currency, checking accounts, we'll do savings, money market, and we'll say we have, what's the last one we had? CDs. So we have all these different types of products or financial products that we can purchase. And what if we had, say $10 million in currency, $20 million in checking, 50 million in savings, say 25 million in a money market, and 10 million in a CD. Let's do 15. That way I'm not repeating numbers. So as an economy, we have this much money. So we may say, what is our M1? So for M1, again, we'll take our currency and our checking accounts, but we won't take our savings, money market, or CDs. So for M1, we'll take that 10 million plus 20 million, and we'll see that we have $30 million as M1 currency. Then for M2, again, we include our M1, but we also include everything else. So our first two was that 30 million that we just found, plus 50, 25, and 15. So our M2 would be 5 and 5 is 10, 5, 8, 9, 10, 12. So $120 million of M2. And if we're interested in how much does the US actually have, we can actually see that really quick. So fun little, there we go. So fun little site out there, at least I think it's fun. Not everyone might, but oh well. We have this site that's called the US Debt Clock. And I'm going to get it pulled up before I switch over. And I may have shown this before, I'm not sure. But we have the US Debt Clock website. It's a really cool thing. It's just a simulation. It's not anything from the government or anything like that, but it's a cool little thing. But what we have in this is these two numbers down here. We have the monetary base and the M2 money supply. So what this does, it tells us, one, how much money is in currency, and then, or how much money is in currency. So it tells us our M1 and our M2 money supply. So right now, it looks like we have, so in the US, right now, it looks like our M1 is about $3.8 trillion. And our M2 is about 16.4 trillion. So if I scroll back over into our OneNote, we kind of have that just as a reference for where we are today, or how much money is there. Let's give that a little box, that way it stands out. There we go. So in the US, we have about 3.8 of M1, 16.4 trillion of M2 currency. So that's kind of how we measure, kind of where things come up. And what they do is they kind of go through and really talk about what each one is. I think we kind of did it. Our coins, currency, that's money in our wallet. Our checkable deposits. These are things that I can go to the bank, I can immediately draw them, I can write a check for it, I can use my debit card, I can PayPal out, whatever I need to do, I can do, and traveler's checks. And then M2 includes all of our M1 plus savings, money markets, and CDs. Savings deposits are going to be your savings accounts. Money market and CDs are other, they're considered higher risk options, but they're still very, very secure. Just, different products that you can buy for your investing or whatever it is you have. So one of the things that comes up, and you have your little cell that we made, and so on. So one of the questions that can come up is, where does our plastic money come in, right? So for a lot of us, we're probably using debit cards, credit cards, um, and even more than cash, right? So where does this plastic money fit in? How does that work? And so on. Sorry. So two of the big things that we see are debit cards and credit cards. And whoops, we don't care about that. We care about those. So we care about debit cards and credit cards. So what I'm just gonna kind of come to the side and show how it works. So if I use my debit card, I have me, then I have my vendor, then I have my bank account. And I should say, this is my bank. So when I use my debit card, I don't like the way that was going to come out. So when I use my debit card, money goes from my bank to the vendor's bank or the seller's bank. Right. And this is something that instantly happens. And if you use your debit card, you can look and see, you can actually see that it says minus $5 to wherever you use your debit card for. So fairly straightforward process. However, when we have a credit card, things are a little bit more, there's a little more to it, but not too much more. So we're going to see happen with the credit card. It will go from the credit card's account into the vendor's account. Okay. So we'll have money flow this way. But then what the credit card company will do is they will say that you owe what they paid. Right? So they're going to say, all right, we paid for your meal, we paid for whatever it is that you had, but now you need to pay us to pay them. And if you run a balance at the end of the month, you'll get some sort of interest charge and so on. So we have credit cards and debit cards. Neither of them themselves are considered money. Right, so with the debit card, it's going from my M1 checking account into the vendor's M1 checking account. If I have my credit card, it goes from the credit card's M1 account into the vendor's M1 account, and they tell them that I owe them, which I'm going to then pay them from my checking account or my savings account, but whatever works. So it's just that we have debit and credit, and we're probably fairly familiar with how they both work. This last one is called Smart Card. We may also think of this kind of like a gift card type deal. But with this, what I might do is I can, if you have like an account with the college or you have an account with, this is saying long distance phone calls. What a smart card does, basically like a gift card, so I'll prepay for my goods, or somebody will hold an account for me at a particular store. So I'll prepay for my good, and then I have this gift card or smart card that can be used anywhere. Common places for this, again, if you think about, like, if you've been to New York, you get a Metro card for subways, right? You have that, but you prepay for it, then it loads up and you can go around whatever you need to do. So the key with this is our cards. The main idea that we see do with them is they don't create money, and they are not money. If I lose my credit card, I can call the bank and then it immediately gets turned off, and so on. And even if you use a credit card in an unauthorized way, so if somebody were to steal my credit card number and use it, hopefully I would get a call from the credit card saying, hey, this doesn't seem right, and that would be canceled or taken care of. But with these, all that these three types of cards do is they move money. They don't create it. They don't They are not money themselves, but what the credit card does is it authorizes a transaction from the credit card's bank to the vendor's bank. Or if I use my debit card, that transaction is authorized from my bank to their bank. Whatever we need can happen. So we have our bits. We get into is what do we actually use for our banks? Like what are they? What is the role? And the big thing that we're going to use our banks for, kind of two bits. The overarching role is that banks are going to link are going to link savers with borrowers. But if for the sake of right now, we're talking about payments and stuff like that. The bank is going to help facilitate a payment system. Uh, yeah, so we'll say the bank's going to help facilitate this payment system. That is, they're going to create a format in which I can send money from my account to someone else's, or they're going to store money so that if I need it, I can go and get whatever money I may need. Right. So if I need to go to the bank, I can run in, grab whatever money I have, assuming I have it, and have that as currency uh, available. And the thing that banks do, the nice part about them, is they're going to help lower these transaction costs. So when you think about if I need to borrow money or if I need to just get some money, uh, but excuse me, if I need to borrow money, right? It'd be if I had to go up to random people and say, "Hey, can I borrow $100? Can I borrow 1,000?" It'd be kind of weird and it'd be kind of hard, right? Because you need to find people that have money to lend you. However, if I have something like the bank, if I need to make a mortgage or I need to uh, borrow money, I know I can go to the bank and say, "Hey, I need X amount of money," and if I can get approved for it, I get approved. If I don't, I don't. But I have one of a handful of places where I can go and seek that instead of having to go out and ask random people. Um, so, what banks do is one, they help act as a payment system. They are going to bring together savers and borrowers, and I'll talk about savers in a second. And they also are going to lower our transaction costs and act as financial intermediaries, which we'll define in just a moment. So whereas yes, so I mentioned if I'm a borrower, right, I can go in and ask for money, but also if I'm a saver, I don't have to go around and try to find. Oops, I don't have to go around and try to find someone to save my money or to pay me interest. So I don't have to come into. So I don't have to walk around to random people, say, "Hey, I have an extra $1,000 this month. Do you want to borrow it from me?" Right? Again, as weird as it would be to ask people for money randomly, it would be probably equally weird to just walk around offering people random money. So with a bank, what we're often going to refer to them as is what's called a financial intermediary. That is, again, they act as that institution between the savers and the borrowers. So again, they help facilitate that process. They make it easy, and they lower the cost of being able to take a loan, being able to save money, and so on. And then to a lesser, not really as important for now, but banks are also depository institutions. That means that what this means is that they collect money, or they accept money deposits, then use that money to make loans. We'll kind of see how that works out in the next little chunk of today. Excuse me. So the next little bit kind of looks at how, in this little graph, it shows how they work and kind of everything I was just explaining. The next little bit we look at is how is a bank valued, or how does their balance sheets work? So if you've taken accounting, you've probably seen these before. We have what's called a balance sheet. This is a tool, lists our assets, liabilities. An asset is an item that a firm owns, and a liability is a item or debt that a firm or an individual owes. We'll see our net worth. Our net worth. So we have these things. If you've taken accounting, you know that assets have to equal liabilities. Our net worth is really going to act as our equalizer. Right. So if we take our assets minus our liabilities, we'll end up with our net worth. And then our bank capital, or what we call bank capital, will be the net worth for the bank. So what this will, or I guess we have to get to the other side first. Right. So yeah, we'll get through definitions, then kind of look at how this works. So what we see come up, or I'm just going to define them really quick. So within our assets, one of the things that we're going to see come up is a thing that's called a reserve. And this is basically money that a bank keeps on hand, ready to go. And our reserves, they don't get loaned out, they don't get invested, they just stay at the bank, they stay safe and in a secure place. And then what we're going to see this last little bit before we move into our next part is going to be what's called a reserve requirement. And the reserve requirement is going to be how much a bank has to keep in reserves. So a minimum amount, of money that must be in reserve. So what we'll see our balance sheet look like is something like this. So we'll have our assets and our liabilities. We'll tend to put our net worth on the right side with our liabilities. Excuse me. With our assets, we'll have loans, securities, and reserves. And with our liabilities, we'll have deposits and net worth. We're making here is this T account. So what a T account again does is it just gets everything in a nice, this nice 2-column format and makes it where we can really see what's going on, and it separates our assets and liabilities. And what we would expect to be is that if we add these three together, they should be equal to these two. So we take 5 and 4 is 9 plus 2 is 11 million. 10 and 1 is also 11 million. So we're happy, we're good to go. So what each of these are, though, loans, these are loans made by the bank. These government securities will be things like bonds. There can be municipal, federal, they're security products, but bonds. Then reserves, again, there are reserves. The money just kept on hand. Deposits is going to be from other firms and individuals. And again, this net worth kind of acts as the equalizer. And as we get into on the last part of today, we'll really dive into this T account and look at some things that can come up with it. So again, we talked about reserves, funds that we keep on hand, and so on. So when we think about what's a good sign for a bank, in general, what we want is a healthy bank. We want our net worth to be positive. Right? And our net worth can also, the way we can kind of think about our net worth, how do I want to put this? Right here. We'll say that our net worth is going to be what part of the bank is actually owned by the bank. Or its shareholders. Okay. So that's what we'll see with our net worth, and that's what we're going to see come up with that. So if that's positive, that means the bank actually has assets. That means it actually owns some of itself. If it's negative, it means that if a bank has negative net worth, it means that if it were to 100% liquefy, it would not be able to cover all of its expenses or all of its liabilities. So that is, our assets would be better than our liability. Our liabilities would be more than our assets, which would not be a great situation. So, excuse me. So what this we can get into is some issues that banks can have. And the two, we have kind of some potential issues. One is a lot of people can, um, oops, hang on just a second. There we go. So we can have a high rate of loan defaults. So a default just means that someone can't pay their loan. Someone is no longer paying their loan. Right. So if one person defaults or if one person, goes bankrupt, it's not really going to matter to the bank all that much. But if we have a situation where, kind of like in the '08 housing crisis, where a lot of people are going bankrupt, a lot of people are, getting foreclosed on and all that stuff, uh, you kind of have a little bit of a different story where the bank starts to actually get into trouble. And during the housing crisis in '08, there were a few banks that closed. So we have these high rate of loan defaults. It's kind of an issue for a bank because if they make these loans and the loans don't get repaid, that's money just gone. The second thing that can be hard for a bank is what's called this asset liability time mismatch. And what this looks like, I can go to the bank right now and take my liabilities and excuse me, I can go to the bank right now, pull all my deposits out, and I expect them to be there, right? So you can do that. However, if I have a loan, I'm only going to pay back my loan in a more of a longer term. So if say I'm moving to Montana, right? If I'm moving to Montana, I'm going to pull my money out of our local bank because the Bank of Boone Bank doesn't do me much good in Montana. So I'm going to go pull my money out of our local bank, and then I'm going to put it into a bank account up there in Montana. So between today and tomorrow, I just went out, got all my money, and took it. However, if I have a loan, whether it be a car payment, whatever the case is, the bank can't say, "Oh, well, Kevin just pulled his money out, so we need to collect on a loan today and get all of our money from a lender or from one of the from one of our borrowers today." Right? So the bank can't just go out and say, "Oh, we need $1,000, so you need to pay us an extra $1,000 today." Right? So liabilities get paid in the short run, whereas assets are more of that, or liabilities can be withdrawn tomorrow, but our assets can only be repaid whenever I want to repay them. So the issue that can come up here is what's called the bank run, and this is where a lot of depositors all decide to withdraw money at one time. And if we all pull our money out of the banks, if we all say, "Oh, I need it on hand," that makes it where banks can't make loans. If banks can't make loans, it hurts businesses, it hurts individuals because they can't purchase. If we can't make those purchases, if businesses can't take loans, they can't uh, they can't hire people. They can't really hire people or do anything like that. If I can't take a loan, I can't go buy a house, I can't go buy a car. There may be purchases I can't make, and so on. So bank runs in general not really good for the economy. We'll see more of them a little bit down the road. We'll see more uh, about them, but that's kind of for down the road. So to handle this risk, a couple things that we can do is we have a couple options that banks can take. The first thing that banks can do is they can diversify their portfolio. So if you've ever done anything with investing, you've heard people say diversify, 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 right? So especially for your long-term investments, you don't want to have all of your you don't want to have your entire retirement account in the cruise industry, right? Just because if something goes wrong with it, your retirement's gone. Whereas uh, if my investments are diversified, if they're set up between a few different types of industries or a few different products, odds are if one of them fails, I have something else to fall back on. So don't keep all your eggs in one basket and so on. So you want with different varieties of firms, different varieties of risks, and so on. The second thing that we'll see banks do is they'll actually sell loans that they make in what's called the secondary loan market. So I might go out today, and I'm not necessarily saying that this bank does this. I don't know, but I might go out to Vision Bank or U.S. Bank today, get a loan, get a mortgage, and what they might do is take that loan and sell it to somebody else. So with this, what they do is they get the loan, then they get paid immediately for that loan, and then another bank or somebody else can hold on to that debt, and basically someone else can buy that debt from them. So we can make these secondary loans, and the second thing that we can do is hold more assets. So keep more money into bonds or reserves that are more secure, and so on. So to reduce risk, you take less risky options. It's pretty much what this is telling us. So the last little bit, this is the part that I really think is fun. So we have this situation, and we're looking at actually creating money. And we saw that we had 3 trillion in M1, 16 trillion in M2. And we wonder, well, does that mean we have $3 trillion printed? Probably not. But let's just see what this looks like. So we're looking at banks actually creating money. And the first two are going to be fairly straightforward. The last one is going to be a little more exciting. So, and what we're looking at is different types of systems or types of banking systems. And we're going to analyze 3 types. The first is, what if there is no banking system? Right? So somehow, some way we have money, but there is no banking system to do anything with it. It's just, if you get money, you need to keep it on hand, and that's the only thing you can really do with it. So in this case, suppose that, and for all of these, we're going to suppose that our initial money supply, or our initial M1, was $100, just to keep things easy. So first case, we have no banking system. This means that I have my M1 is equal to $100. It can't go to a bank. It can't go anywhere. So it can get moved around some, but with no banking system, we'll see that M1 will remain $100. Really nothing too exciting. It just stays there. All right, if I have $100 in my pocket, it's gonna stay $100. It's not gonna change. It's not gonna turn into 200 or anything crazy like that. The second bit is, what if I have a full reserve banking system? And what this means is that we keep 100% of our deposits in reserve. So with this system, we can start to get into our assets and our liabilities and so on. So we have our assets. and we have our liabilities. So in this case, we're going to see this come up. We have our deposits at $100. Oops. And our assets will give us we'll see we have our reserve, which will also be at $100. So in this case, my M1 went from currency to a checking account. So basically our M1 went from $100 in M1 to 100 in M1, and still it's $100. So again, our M1 remains $100. And again, still nothing crazy exciting happening. Just, it goes into the bank. The bank can't really do anything with it, so it stays there. But the third system is where things kind of start to get a little more exciting. So we have what's called a fractional reserve banking system. And with this, we're going to suppose that we set our reserves at 10%. So 10% of our deposits we keep on reserve. The other 90% we loan out. So in this case, what we're going to see is we have kind of the same thing as before. We have assets and liabilities. In liabilities, we're going to have our deposits. And with our assets, we'll have our reserves. But also, we get to make loans now. So we said that we have $100 in liability, or in deposits. But if I'm going to keep 10% of that, this means that I have $10 in reserves and $90 in loans. Now at this point, I had that initial $100. So I have $100 in a checkable deposit. But our second player, but our borrower just received $90 in currency. So together, I have $100 in a checkable deposit and $90 in a currency. So at this point, my M1 is now $190. But this kind of keeps going. So this borrower now has $90 in loans, but they're going to take that $90 and throw it into another checking account. So again, we'll kind of start like we did before. Oops, what did I just do? There we go. So we have our assets and our liabilities again, and we'll kind of do this again, right? So we'll do this again, and this time we'll see that our deposits will be sitting here at $90 instead of 100 because let me do a little bit labeling. For our first bank, we were at this situation. Then they're going to go put it in their bank. So in a second bank, we have this. But now this $90 turns into $9 in reserves and $81 in loans. So again, I have $100 in deposits. Borrow one now has $90 in deposits. And borrower two has $81 in currency. And if we put all these together, this comes out to $271. And this process kind of keeps going on and on and on until we get into what's called our money multiplier. And basically what the money multiplier says is that it tells us how much money will be created by the banking system. So if we have, say we have a reserve ratio equal to R, we're going to say that our money multiplier is going to be equal to 1 over the reserve ratio. And we're going to note this where 10% is equal to 0.1. So in this case of $100, so in our example, our reserve ratio was 10%. So reserve ratio is 10%. So our money multiplier, will be equal to 1 over 0.1, which would be equal to 10. So what this means is that we can take our M1 will be equal to our initial deposit times our money multiplier. So this would mean our initial deposit was $100. Our money multiplier came out to be 10. So if we keep doing this process that we were doing over and over and over again, we'll get that our money supply will come out to be $1,000. And this is where a lot of our currency, a lot of that money that we saw is actually coming from this. So a lot of the money that we have is just, how do I put it? It's come up through debt. And a couple things to note. Just because it came up as debt, or just because we're creating money, does not mean we're creating wealth. If we create more money, we could run into an issue with inflation. But money creation is not the same thing as wealth creation, but it can help because, excuse me, our loaning process can help get kind of things going. If people are spending money, then goods get created, so on and so on. So we kind of see this process come in, and over the next couple weeks, we'll dive more into this and kind of see what we can do with everything. But this is how we create money, how money gets created, and so on. And again, it just follows this a pattern. Then somebody else would take that $81, throw it in a bank, and so on. And that process will just keep going until we get up to this $1,000. So that's what I have for this chapter. I'm going to stop the recording, then I'll close y'all out.